Hi, this is the first video for Chapter 2, and it's going to be on terms that you need to know. You're going to be seeing these terms throughout the whole course, so it's very important that you understand what they mean and what accounts are included in that category. Now, these are accounts here, cash, equipment. I'll explain that to you as we go on. But there are 6 major categories that we're going to be using: assets, liabilities, owner's equity, drawing, revenue, and expenses. And I'll explain to you what those are as we go on. So we'll start with assets. So assets, you may have heard that term before, or usually related to good things, like, oh, she has a great personality. She'll be such an asset to her personality. She's going in sales and she's so friendly. What an asset she has. So assets are things that we own. So in a business, we're going to be looking at, instead of personalities, which is intangible, we're going to be looking at things that are real, that you can touch and feel. So some assets that you have in a business are cash, and the cash is going to be the money that you put in your business checking account. You cannot mix your personal and business money together. You have to have 2 separate accounts. So we're looking at through the eyes of a business. So this is going to be your cash, business cash account. If you buy equipment, you're going to, a big piece of machinery, you're going to put it in the category of equipment. Accounts receivable is a very unusual asset. It's not a common asset, but in accounting it's a very important asset. It means when a customer owes you money. When someone owes you money, we're going to put it in accounts receivable. You may do a service for someone, perform a job for them, and they haven't paid you yet. We're going to put it in accounts receivable. 2 other unusual assets are prepaid rent and prepaid insurance. Normally, rent and insurance would be an expense, but because you're paying them in advance, prepaid, paid before you use them, we are going to put it in the asset category. So if the transaction says, the wording says, paid rent for the year instead of for the month, we're going to put it into the asset category, prepaid rent, because you haven't used it yet. The next group are liabilities. Liabilities are not good. Those are debts that you owe. So you don't want to have too many debts, too many liabilities. But you owe those debts on something that you bought. Perhaps that equipment that you bought, you haven't finished paying for yet. You charged it. So accounts payable and notes payable are 2 liabilities that we're going to be using, mostly always accounts payable. That would be like your charge account. So these are debts that you're going to pay off within the year. Notes payable would be long-term debts that would take you longer than a year, like maybe your student loans or a car note. That would be under notes payable. Those are liabilities, money you owe for something you purchased. The owner's equity is the owner of the business's investment in the business. Equity means how much have you invested in that business. So when the owner makes an investment in the business, that is going to be his equity or his capital. The name we're using for owner equity in accounting is capital. Drawing account is money that you're withdrawing out of your business for personal use only, not for anything in your business. You're not buying something for your business with that money, but you're taking it out to go on a vacation with your family or for some other reason, to buy a gift for someone. That would be in the drawing account. The revenue. Revenue is money that you're earning. What is your revenue? What is your income? So that's money that you earned. And your book many times calls it fees, but it's not fees that you're paying. They're referring to fees that you're earning. So I like to put the word earn behind it. So fees earned would be your revenue. Expenses is money that you're paying to run your business, to keep your business operating. Things like telephone. We need a telephone. You need to pay rent. If you're renting a building or an office, you need to pay electricity. Gasoline if you have a car or a truck. And if you have someone working for you, you need to pay wages. So it's very important that you understand these categories. So if I say to you, where is your rent going that you'll be paying? That is an expense. Fees that you're earning would be a revenue. Withdrawal for personal use would be the drawing. An investment by the owner is the owner equity. An account payable, money that you bought and charged it to your Visa bill, is a liability. And anything you buy, equipment, or a customer owing you money is an asset. So these are the categories that we're going to be using, and you need to become very familiar with it. So the next video I'm going to be showing you is where we're going to be using a worksheet, and we're going to be reading a transaction. That's an event that happened involving money, an exchange between two people or a company and a person, like going to Burger King to get a hamburger. They're giving you the hamburger, you're giving them money. That's a transaction. So we're going to be taking the transactions and putting them in a worksheet, and that's the next video. So be looking for that one next. Thanks. Bye-bye.